Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Brynick, and this week I'm joined by Shiraz Mian, Zach's Director of Research, to talk about the earnings outlook for 2021. What does it look like after this crazy year with the pandemic? We know some companies are doing really well. Some areas of the economy are doing really well. Can they keep that momentum into 2021? And how expensive is the stock market, both the large caps and the small caps? A lot of people talking about how it's overvalued, Shiraz, here going into 2021. But is it? I don't know. We're going to discuss it, because that seems to be the biggest fear that's out there, I feel, about the overall market, at least, is that, it's too hot, it's run too much, and it's way overvalued. I get these emails and tweets from the bears saying that it's worse than the valuations than in 1999, and we know how that ended.
That's right.
Should I be concerned about these things? What do earnings look like going into 2021?
So let me just address the valuation question first.
Okay.
And then we can go into the earnings. The valuation question always, since there is a high degree of subjectivity involved in valuation, it's always a heated debate. And your references to 99, and there's this talk of these bubbles and the specs and all of that. So if you look at the multiples on an absolute basis, and you say for the S&P 500, it's 22.5. As you look for the small caps, the Russell and others, those are at multi-decade highs as well. And that's the only measure for you that you use to determine value, then yes, we are totally in uncharted territory. And if that's how the markets behaved, then perhaps the outlook is a lot more scary. But I never bought into the valuation multiples as the only framework for determining value. Interest rates are as big a determinant of stock prices as earnings are. And the interest rates that we have now, we have never had that in history either. Right. And a sub 1% interest rate in that environment, a 20, 22, 23 times earnings multiple is a lot lower in reality relative to what we had in 99, 2000, 2001, when interest rates were, the 10-year yield was north of 5%.
Yeah.
So it's you can't look at these things in isolation. You have to look at the complete picture. And I think when you do that, I don't think stocks are overvalued or there is a bubble or we are anywhere near the craziness that we went through in the 2000s and 99. I mean, for some of the new folks, that's probably what they read about in books and stuff. We actually went through that period. That was different.
Yeah, it felt a lot different than what it feels like out there right now.
Sure.
I remember seeing an interview with Warren Buffett, maybe, I don't know, it was before 2020, so maybe in 2019, one of the ones when he was on CNBC, and it was where you could send in your question to Becky Quick and she would ask him. And they were asking him even in 2019 about the stock market being a bubble and being overvalued. And he gave the response you just gave, not with the interest rates this low. And that was before they went even lower.
Absolutely.
So he was also looking at the same thing you were. And he said with the rates at those levels of 2019 even, that he was a buyer of stock all the time at those levels.
Absolutely. Yeah. In 2019, we were in this 1.5% to 2% range.
Yeah.
Which, if you look back the preceding 20, 30, 40 years was extremely low. And what we have now is totally unprecedented. And on top of that, we have the Federal Reserve effectively guaranteeing, I mean, to the extent that a government entity or a regulatory entity could guarantee anything, they are saying we will not raise interest rates for a very long time. And people define the very long time anywhere from 3 to 5 years. And so you have a sub 1% interest rate and an outlook in which interest rates are expected to remain low for a very long time. And you couple that with outlook for the economy, outlook for major parts of the economy that have some real momentum behind them, I find it hard to get bearish on stocks in that environment.
Does the possibility of having Yellen at the Treasury along with Powell at the Fed also boost your view of stocks in 2021?
Yes, it does. But to step back from that, Tracy, the tight fiscal policy narrative, the narrative of deficits being something to worry about, that has been destroyed and killed in the political elites over the last so many years. So it's possible that these things come back. You never know what politicians will take up a point to kind of raise their own profiles on. But spending without regard to whether it's borrowed money or raised money through revenues has been the norm in the U.S. and all over the world for a very long time. And I think that will remain so. Now, the fact that someone as credible as Yellen will be in the Treasury, who has a certain reputation on this issue, and then Powell obviously is someone that the market has seen and known, totally gives credence to this growth outlook.
Okay, well, that sounds bullish.
It is.
So let's take a look at the earnings then, because they are expected to rebound into next year. But should anyone be surprised by that? Because they declined this year.
Yes. So we had about a 17% decline this year, and we will have a 21.5% growth in 2021. And the overall level of earnings in 2021 will effectively reach where we were in 2019.
Okay.
Now, this is what I'm describing is the bottom up aggregate consensus estimates. So all the hundreds and thousands of analysts around there covering their individual companies, we aggregate that to the sector and then the aggregate index level. If I have any worry or doubt about these estimates, it is that they are undercounting the potential growth in 2021. And the reason for that is that the traditional framework that all the analysts use for making estimates is based on this model of how companies and households and industries behave as the economy comes out of a recession. And for history, they use the last 20, 30, 40 years of behavior as they know and as has been documented in the economy. The thing that's different this time, and that's always a worrying thing when somebody says this is different this time,
Right.
that the recession was different.
Yeah.
This was caused by a healthcare issue. So the output impact and the production impact and the impact on growth was very severe and very fast. But once the healthcare issue is on its way being addressed, it is reasonable to expect. This is not my base case outlook, and obviously this is not anyone's base case outlook, but there is a reasonable chance that the growth next year will be a lot faster than what consensus numbers currently project.
Okay. What do you see as the like year over year issues that we're going to have? So for instance, maybe not so much in the first quarter, but the second quarter that was, severely impacted by the first wave of the shutdowns in the economy. Year over year, companies should be able to easily, beat whatever they did last year. But then by the third quarter, as things reopened this year, things got better. But can they still exceed that in, 2021? Can they beat the quick comeback that they had this year into next year?
Yes, I strongly believe they can. And yes, to your point that the Q2 2020 estimates, if you look at the today's estimates for Q2 2021, they do represent a huge year-over-year gain. In fact, for the S&P 500, the earnings growth is expected to be 40.4%.
Wow.
And the reason for that, as you alluded to, is that the 32.3% decline we had in Q2 2020, and then things normalize beyond Q2 2021. So we have a 12% growth in Q3. The estimates will evolve as we go through the new year. As we get these Q4 results in January and analysts digest the commentary from management teams, we will have estimates for Q1 and Q2 adjust. That's the norm. That's been the norm all along. The last few quarters, the last 2 quarters to be precise, estimates have been going up as we start seeing earnings results come in. In the past, it was the reverse. Estimates would go down. My sense is that as we go through the coming reporting cycles, estimates will keep going up and perhaps go up at a pace that's higher than what we have been seeing over the last 2 quarters.
Okay. Now let's talk about one of the big sectors that everybody cares about and that's really driving this market, and that's technology. I saw that it's 31.8% of the S&P 500 now. It's by far the largest sector in the S&P 500. Number 2 is at finance at 12.8 now. So what's happening in tech? I saw in the third quarter that Amazon, they're killing it, and they drove a lot of, well, this is on retail. Sorry, we have Amazon in the retail sector.
That's right.
But on Amazon, on the retail side, they drove a lot of what was happening there. And on tech, because Apple and Intel are so large now too, on the tech sector, they drove a lot of what happened in the third quarter there. What is going on with these huge, massive companies? How are they impacting what's happening now with even just like the sector, outlooks and things like that?
That's right. Yeah. So these major companies, you mentioned Apple and Amazon, then you have Microsoft and Google and Facebook. All of these are not only big in terms of stock market capitalization, but they are also huge earnings producers. And despite their enormous sizes, they also have impressive growth numbers still. So these are companies that still produce double-digit top-line growth. and multiples of that on the bottom line. So very strong growth in the technology sector. In fact, of the many areas that effectively took the pandemic in the stride and didn't show any major slowdown or impact on profitability, technology has to stand out in that. And it's actually we all use technology even before the pandemic, but the fact that technology enabled us to continue operating and continue working, and not have to commute to work and not have to have the regular interactions that we had always associated with normal living is just enormous. So that trend continues, and technology is a major growth producer in 2021 and beyond as well.
Yeah. So I think people are always surprised to hear, because I've tweeted this little stat that you included in your earnings articles about how Apple earnings actually declined 3.9% in the third quarter and Intel's were down 22%. So between those two, they actually pulled down the entire sector from, it would have been 20.4. And then if you strip those two guys out, well, no, it was 12.6. If you strip them out, you got 20.4% earnings growth just by removing those two companies.
That's right. Yeah. So Apple and Intel were drags on the overall technology sector growth in Q3, and the picture is actually a lot better once you take those companies out, and that's actually not unusual for the sector. All these other companies in the sector, the Googles, the Microsofts, the Facebooks, and many others have been doing extremely well. And when you look at consensus estimates for Q4, for Q1 21, for full year 21 and beyond, that shows continued momentum from the technology sector, and that's one of the reasons why. Just getting back to the earlier discussion we had about valuation, that unlike 99 and 2000s, where there was a lot of hot air and a lot of hopes and dreams about these stocks, the big winners of the stock market in the recent past have been companies that are enormously profitable and generate a ton of revenues.
Right? They're actually executing, unlike 1999.
That's right.
We wanted them to execute in 1999. We hoped in the coming years they would be executing, and now they are.
That's right.
Basically. Okay. What about the S&P 600, the small caps? Because they're suddenly hot. We've talked about them before when we've done this podcast on the earnings. But I don't think many people were really paying that much attention because all they do care about it was small caps. But now, after the hottest month ever for the small caps in November here, suddenly I'm kind of interested. So do we see a similar bullish outlook for their earnings in 2021 as well?
Yes, but for different reasons. So the one difference that we have to keep in mind when we are thinking of the small caps versus the large caps is the composition of how the indexes are designed. So the S&P 600 or the Russell 2000, which is kind of like the proxies for the small cap, technology is not as big of a deal as it is for the large caps. Finance is, energy is, medical is, and the outlook for those, while not as strong as it is for the large caps, is a lot better than what we have seen over the last many years. Okay. So if we just look at the pure growth numbers, the S&P 600 2020 earnings are on track to be down. We still don't have the Q4 numbers yet. We have the first 3 quarters and estimates for Q4. So the 2020 earnings are on track to be down 29.4%, but 2021 earnings are expected to be up 35.9%.
Wow.
And then there is a 21% growth expected in 2022 as well. So a very strong growth spurt is expected for the small caps. And one other small comment. This was related to the comment I made earlier about how the risk is to the estimates being revised higher. If that thesis plays out, that will have an even more pronounced impact on the small caps than it would have on the large caps, because the small caps are a more domestic-centric businesses than they are for the large caps.
Okay. And how does it play in that there's not, as much analyst coverage of the small caps? Does that mean they're going to be, not cautious, but are they going to, is that going to skew what we see going forward even more so than like the large caps will? Like, are they underestimating what the small caps are going to do just because there isn't quite as much, people looking into it, or I don't know, eyes on it?
It makes life difficult for folks like us who are in the business of keeping track of these companies.
Yeah.
And this is the reality, that there is a lot less coverage for the small caps. Let's hope that the sunshine that the group has started getting in recent days is not just a fleeting phenomenon and is something enduring, and it will continue in 2021. The reality is that for regular investors, the opportunity of finding real gems and making real money is in the small caps.
Yeah.
These are the companies that are that have still to be found. Everybody knows about Apple. Everybody knows about Google and all the other amazing companies that are there. And 80 of those large caps are covered by 20, 30, 40 analysts. So the opportunity to make gains that are above anybody's expectation is a lot less over there than it is in these small caps. So hopefully, if there is a lot more interest in these companies, if these stocks are going up, if they gain more weightage in the market, there'll be enough demand in the marketplace to force these brokerage firms to devote more attention to these stocks.
Yeah. Okay, so on that note, let me ask you this. You run Zach's top 10 stock portfolio that comes out in early January every year, and it's
That's
the
right.
top 10 stocks of the year that you pick. I never know, no one else at Zach's ever really knows what you're doing with it, but given your analysis that you just gave, are you looking more at some of the smaller cap type companies for the list going into 2021 versus the large caps?
Yes.
Okay.
That's always been my desire and interest in picking stocks that are not household names to begin with.
Okay.
And if you look at the top 10 portfolios for the last many years, the bulk of the stocks would be in that category. And while you brought it up, Tracy, we had some amazing performance in 2020. The top performing stock in the portfolio is up 400%.
What? I don't. Wow. What? Can you tell me what it is?
It's a company called C Limited, SE. This is the equivalent of an Amazon in Southeast Asia.
Okay.
And then we have another stock that's up 200%. That's DocuSign.
Oh, yeah. Okay, so just to be clear, you bought that in January 2020, DocuSign.
That's right. So around this time last year, I'm currently in the process of putting together the list for 2021. Okay. So around this time last year, I shortlisted this portfolio, and there were a couple of other names on my short list that I didn't pick. TDOC was one of them.
Oh.
And so it's so yes. To getting back to your question, small caps provide the best opportunity for outperformance for all of us. For those of us who are in the business of doing this, like you and I, but for regular investors saving for their retirement, it is the small caps that a lot of the people are not talking about. And if you do see your research on the opportunity of picking stocks that will grow for years and years to come, is a lot higher there than with an Apple or NVIDIA.
Yeah, I've always said as well as, the FANG names or FANG man or whatever you want to call them, the big cap guys are doing, and it's been phenomenal what they've been able to, the growth rates that they're still doing. But eventually, Alphabet won't be able to grow those revenues 20% a year anymore. Right. I mean, I'm shocked they're still doing it 20 years on, but eventually that will slow. It just will. So, yeah, to find that kind of growth, you have to go to these small caps. I've got a couple small caps in my value investor portfolio that I'm surprised at how well they're doing, but the small caps in general now have exploded. So it's being caught up in some of that momentum, but it only has one estimate on it on Zacks.com. So, and, very few people follow it on StockTwits. No one knows what it is, right. But it's those types of companies. If we're going to see a boom come out of this pandemic, that are really going to see big growth.
Yes. And this morning, there was a note from Goldman Sachs, which made me feel good about this thesis I've been having for a while, that the likelihood of the recovery in 2021 could potentially be stronger than all of us are projecting. Goldman 2021 GDP growth estimate is 5.3%. Wow. The consensus number is 3.8%. So and a lot of the reasons they give for being so out of the range for consensus are along the lines of what we discussed earlier, that this is a different type of recovery. The nature of the pullback was different. The forces holding the economy down were different. And as we come out of it with the help of vaccines and therapeutics, the impact that will have on us as consumers, on households, on companies will be different than what we are used to seeing coming out of recessions.
Yeah, for sure. Okay, well, I'm excited about your new top 10 now. I always get excited, but now that you're talking about the process and all that, I'm interested to see what's going to be on that list. So anyone out there, if you're interested, it launches at the beginning of January. So go on Zacks.com, you'll see ads on their way you can sign up so you can get the new top 10. And then they'll still see what happens to the old top 10. Is that still on there, or does that go away immediately?
So it remains through the end of the year. Okay. The one that we were discussing earlier, that is on the site currently, and it should be there.
Okay.
And I think if they if they do like one of the trials or something like that, they could see this and other portfolios.
Okay. Well, that's good to know, because it does sound like things are looking like they could be very bullish in 2021.
Yes,
Yeah.
I agree.
Yeah, I just listened in on the conference call for Toll Brothers, and it was so bullish in this last quarter for them that they were intentionally slowing their business. They were like restricting how many homes certain sales centers could sell, because they don't want to get too many orders, because then their backlog is like, it puts a strain on the rest of the business, because they don't necessarily have enough construction workers and
That's
like
right.
the land, and you need the electricians and the plumber guys and all that. And so they were intentionally trying to restrain some of it. And I haven't heard anybody talk about that.
That's right.
So,
That's right.
So yeah, we'll see. They see these trends going on into 2021. And that's what also I feel makes it very different from a normal type of recession, because you don't see housing doing that during a recession.
That's right.
So we already have certain areas of the economy, doing really well as we get those vaccines and all of that coming.
That's right.
Okay, so if you're interested in buying the small caps and you don't want to necessarily buy individual stocks too, I always recommend the ETFs. There are a couple of small cap ETFs out there. There's the iShares Small Cap ETF. It's IJR. And then there's the S&P Small Cap 600 ETF, which will track what we were just talking about, the S&P 600. That's SLY. And then there's the Russell 2000, which is obviously 2,000 stocks instead of 600. And that's IWM. And then we also mentioned a couple other stocks here today: Apple, AAPL, Intel, INTC. And then at the end here, a couple that are in the Zacks top 10 right now. SE is C Limited. Shiraz, you said?
That's right. That's right.
SE, DocuSign, DOCU, Teladoc. Is that TDOC? Teladoc. And so, yeah, be sure to check out that top 10, because that's always a fun portfolio, and it had a great year this year, and even the year before that. I just always check it out because it's always interesting to see what names make that list. And as always, you need to subscribe so you can get all of our podcasts here at Zacks on Market Edge, because we're going to be covering everything that we see maybe coming down the pike here in 2021 over the next couple of weeks. So you can get us on SoundCloud, of course, and many of you are on there, but we are on Spotify and we're on Apple Podcasts. But get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.